Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 16th of 2023. We'll start the pack this week with some of the important data that was released last week. Obviously, a lot has been hinging on the inflation data, and we did get that number. You can see here the chart of the monthly data for core consumer prices, which is really what everyone's kind of drilling down on. I mean, we've seen a clear deceleration in the headline number, but the core number, which to remind you excludes food and energy, which can be quite volatile, you can see here has been rather sticky for quite some time. In fact, we haven't really seen that a tremendous amount of traction in the downward slope of core consumer prices, but we did this past week, and so that had several ramifications for consumer sentiment, for the dollar, for expectations, and I think for this general euphoria that seems to be building that we've we've dodged a bullet, so to speak, and we're going to have that soft landing that everybody wanted. Well, the last chart you saw was the monthly data. Here's the year-over-year data. You can see very clearly here that the overall CPI was just under 3%. That's the lowest that we've seen since March of 2021. The core CPI here at 4.86 is the lowest since October of 21. And you can see the clear downtrend there. And like I said, core CPI had been a little sticky, and this latest reading showed that clear downtick. Now that's what we're trying to get down to 2%, mind you. So that's our bogey right there. You can see that much of the data series going back at least a decade, if not more, is kind of hugging around that 2% line. And that's our ultimate goal. And obviously headline inflation is getting there a lot faster than the core. But again, it's still going to require some work. The big question right now is whether the Federal Reserve holds off on rate increases, and we're very likely to see one on July 26th when they meet again, and vote and release that vote results there. Do you continue to ride that horse, or do you get off and let the economy kind of work its own path, so to speak? If the path for inflation, at least, is on the downside, then there's a groundswell of argument that suggests that maybe we should just sit on our hands. But I'm not sure that the Fed is going to be wired to do that because we have such a gap remaining in core prices to the 2% target. We have the components of the year-over-year change in CPI. You can see that a lot of different things going on here in this chart. But basically you can see in the blue here that we've had a significant deceleration in gasoline prices, gas utilities, even a deceleration in used car prices relative to a year ago. And those were some of the most volatile components as we looked at this data this time last year. But you can see the rate of change in electricity, deceleration there, food at home, new cars, apparel. And you see here the overall CPI. Last year at this time, we were talking about 9%, actually 9.1%. And so now, we're down roughly around 3%. So obviously good things have happened between now and then. Still need more room for this to evolve. And you see here transportation is roughly flat, slightly down. The real gotcha here is shelter. And we'll talk about shelter in a second, but this is one of those real sticky components. Rents and wages are real sticky here. And so shelter is actually up year over year, but as we'll see in a few slides, that is in a rolling over mode, and we're beginning to see that decelerate too. So that particular line item bodes extremely well for the future for inflation. Here we have producer prices, PPI. On the upper left, you see month over month. Those prices were up slightly after having a preponderance of several months there where that data was negative and trending in the right direction. Now, we do know at the producer level, prices have abated. So we'll see that in just a quick second. But I want to focus on just the producer price index, the index itself here. But when you look at core PPI on a month-over-month basis, that's in the upper right, you can see that moving down. Then that's in clear deceleration. And instead of just looking at the month-over-month data, I wanted to show you there in the bottom the year-over-year change, which is actually very pronounced. So it's moving directionally the same way that consumer prices are, but we've seen this downward deceleration, if you will, in PPI emerge sooner than consumer prices. And as you might expect, producer prices, not that price savings are necessarily being passed on to the consumer, but in many cases they are. Here we have a chart that kind of depicts CPI, producer prices, as well as imports and exports, essentially net trade prices all on a year-over-year basis. And we've already talked about the CPI, and the overall producer price index, which was on the last slide, is basically flat. We're basically seeing very benign, little if no change in producer prices on a year-over-year basis. And then, as we mentioned, CPI is up about 3% on the headline number. But you can see here very clearly that both import prices and export prices are down year over year. There has been a kind of a net contraction of trade, if you will. We have seen a bit of a manufacturing recession, if you will, as some of the manufacturing data has been, in witnessing kind of a flatly a decline, if you will. But you've got trade prices which are in deceleration on both sides of the ledger, and again, that helps to feed into future inflation expectations. Here we have certainly a lot of data, but things that I want to talk about that I alluded to earlier, rents. So upper left, really important here in the red, we have the shelter consumer price index, essentially the shelter component of CPI. In the red there, you can see it is down over a period of a couple months from 8.2 to 7.8%. And that's superimposed against the rental prices that are published and analyzed in the market. So these, you can see that the number moves slightly differently and perhaps a bit more amplitude to this data series here. But you can see rents went way up after prices, and rents move at a lag to price growth. And obviously we had a lot of that in 2020, 2021, and then that's really dropped off. So in fact, we were negative on quoted rents for the first time in a long time, since at least January, February of 2021. But you can see the impact on the shelter component of CPI. It's beginning to roll over a little bit. You can see that in the upper right, you've got vacancies at their highest level in 5 years. At the lower left, you can see the impact on CPI if you exclude not only the volatile components of food and energy, which give us the core CPI, but if you also exclude shelter, you can see that drop is even more pronounced. So shelter is the real bugaboo right now. And if we didn't have that core, what they call the super core prices, would not be, basically about 4.9, but they'd be a lot closer to 3%. And then, one other thing I threw in there for rents is that it's not geographically focused either. Rents are down all over the country. You can see the U.S. rent index and then these various states there. So this is not a regional phenomenon. Rents are coming down everywhere. Here we have in core CPI and then core services too, which is an important component there because services matter much more to us, relatively speaking, than manufacturing does. And you look at core prices on the service side, if you back out shelter, coming down at a pretty strong clip, actually a stronger clip than core CPI is. And then that's superimposed on the left here with the gray line, which represents wage growth, which we know wages have been very sticky, around 6%. But it's important to also note that real wage growth has finally exceeded inflation for the first time in a while. And so this is good from a consumer standpoint. And if you're going to argue that we are on a path for a soft landing, you really need to see some relative strength in wage growth, and we actually do have it now. On the right-hand side, we have expectations for rate cuts. You can see the kind of the nature of this chart is that when it begins to flatten out like this, then expectations for future rate increases really are waning, and that's exactly what we're seeing right now. Here we have the probability of a rate increase at the July 26th Federal Open Market Committee meeting. There was a 93% probability of a 25 basis point rate increase now. So it's pretty well baked in, and what happens after that has yet to be seen and has yet to be written. And the Fed has said that they're going to be data dependent, but clearly if you see continued deceleration in inflation figures, then you would expect the Fed to maybe let that part of it run its course and not keep their foot on the pedal. But there are more and more voting members on the Open Market Committee that are advocating for a pause than that are necessarily advocating for continued rate increases. But there's still some of those too. So I think we'll have to wait and see. Now, the next meeting after this July 26th meeting is going to be in September because they meet every 6 weeks. So, we will certainly have the August Consumer Price Index, the CPI inflation data to look at before we begin to make some bold predictions as far as where interest rates are going to go. Here we have kind of a synopsis of what's happened here today. And you can see on the left-hand side, really for more, actually both of these are for visual impact, if nothing else. You can see the dramatic rate of gain in short-term interest rates from the commencement of the rate increase cycle here. And the right-hand side, again, for effect, shows you the rate of gain and what we've seen to date relative to other rate tightening cycles. And you can see very clearly that we have moved, the Fed, I should say, has moved at a much more rapid pace than they have in all of these other periods. And so this has contributed to a lot of dislocations. And so, but they were coming off 0% boundary, meaning that they were, interest rates, short-term interest rates were essentially zero for a long time. And so it took the Fed a long time to raise rates above inflation. And we're going to look at this in just a second. So, when you start talking about, how rate increases, lead to recession and economic slowdowns, and you also talk about, well, wait a minute, we haven't seen a recession yet, and we kept expecting one for the lion's share of the year to date so far, but we haven't seen it. Well, I think some of the answer lays in the fact that we're starting from zero, and interest rate increases have, only, at some point, in the not so recent past, have finally eclipsed the rate of inflation. And that's where, when you get short-term interest rates above inflation, that's when you really begin to see the impacts of monetary policy. Here we have the Consumer Price Index year over year, and that's superimposed against Fed funds. So as I mentioned before, for the first time, we have finally seen short-term interest rates as managed through monetary policy by the Federal Open Market Committee and the Federal Reserve there. We finally have seen that eclipse consumer price inflation. And, you have to go back a little ways to see the last time that this happened. It inflected briefly right before the pandemic. But before that, you really have to go back to, at least 10 years to see that. Consumer sentiment has been positively influenced by the decline in inflation, and even though we're at depressed levels relative to the pre-pandemic period, we have seen a rather dramatic spike. Now, mind you, of the sentiment figures that we track, this University of Michigan number tends to be more influenced by people's perception of inflation, not only present but also future. But intuitively, if you think that inflation is dropping and you can see it in the data, then your expectations, your sentiment improves, and that's what we're seeing here. Here we have the probabilities of recession in the next 12 months. This is a survey of a bunch of economists, and as we all know, sometimes you take predictions from economists with a grain of salt, but it is helpful to understand at least where their sentiment is changing, and you can see a little bit of a fish hook down in that probability. I'm not saying it's a huge move, but if you're looking at something that was like 61, 62, and now it's maybe 55 or something like that, it's directionally, it's important to recognize that even from the economist standpoint, they've admitted or they issued their mea culpa, saying that, well, maybe we were wrong in predicting this recession happening so soon this year. Not to say that it can't happen, it's just the probability of which, as viewed by all of these economists that are surveyed, has gone down. Here we have the Economic Surprise Index from Citigroup, and it breaks that out between hard data and soft data. And what does that mean? Well, the hard data is the observable computed data for like new orders, shipments, utilization, factory utilization, those types of things. The soft data refers to sentiment and survey data, and this is data of people expressing their thoughts on and indications on spending intentions and hiring intentions and things like that. Whereas the hard data is really the data. Data don't lie, as they say. So when you talk about shipments and orders, that's readily observable. And so, but you see in both of these components that we've witnessed more surprises in on a net basis. Both data we've seen basically net positive data here as of late. Here we have TSA checkpoint numbers. We all know that anybody who traveled over the last month has certainly can certainly empathize with the frustrations of travelers and missed flights and canceled flights and so on and so forth. But really, it is indicative of a lot of travel. When you think about the service industry, wages remaining fairly tight, hiring, oddly enough, remaining fairly tight. A lot of it has to do with the service sector and in areas that were so bludgeoned in the pandemic, like hospitality and entertainment. Those areas were really hammered, and they've come back. And so, at a time where if you were expecting to be on the front edge of of a recession here, you certainly wouldn't be seeing people travel and budget for experiences and spend money. Now, granted, they're doing some of this on their credit cards and spending out of savings to make these experiences happen. But here in the data, you can clearly see that on a trend line basis relative to pre-pandemic, that travel is fairly robust. Well, every story has a flip side, and so I've got a couple charts here to kind of, not necessarily slap us in the face, but just make us realize that it's not all peaches and cream here. That we've got bankruptcy filings that clearly have moved higher, and in fact approaching levels on the 4-week moving average that mirror what we saw following the pandemic. And that's enough to get your attention. Again, there's a lot of positive sentiment out there in the investing world right now as far as like this soft landing is concerned. But, make no mistake that there are some cracks out there that we need to monitor very closely. Here's another area that I think we should continue to monitor closely. Credit card delinquencies are rising in small banks. I've had some of these credit charts out there in the pack over the last month or so because people are clearly using their credit cards, and you can see delinquency rates beginning to spike. I mean, for all levels of credit, whether it's unsecured, whether it's revolving credit, which is what credit card is, or even mortgage delinquencies are beginning to pick up. But this chart, again, it just makes you stop and take stock that that there are cracks in this economy that we need to pay attention to. That I still believe that we're in for that slowdown. Now, I don't think we're. I agree with the people that say that we're not due for a big recession, and I'm willing to concede that perhaps there is a pathway where we don't hit recession, but I think the pathway that we're heading is that we're apt to witness a slowdown that could linger for a little bit while some of these inconsistencies and things like that kind of work themselves out. Here we have commercial real estate, a little update there. Obviously, this is a part of the economy that is getting a lot of publicity lately. You certainly have office that you're seeing some stress in here now, and you've got essentially 1.4, $1.5 trillion of commercial real estate loans that are tied to office that will be coming due over the coming couple of years. And so credit quality and those borrowers being able to roll that credit is going to be pretty important. You can see in the upper right, transaction volume is down. You can see property prices are down, and we've got the present day data in that blue superimposed with what we saw during the global financial crisis, and so we're we're tracking on that same level. And you got construction spending, which ironically is really not that bad, despite the decline in prices, despite the rise in loans on bank balance sheets. We're still seeing more construction activity overall. I thought this was an interesting chart that really doesn't have as much value to us as we look at it, and say, well, how does this impact the current environment? I'd say not so much, but on a going forward basis, looking out over the next 2, 3, 4 years, I think this has a tremendous value to us, and it really helps to inform our maybe opinions on the economy. You can see here that you've got these areas that are represented within these circles in the green here: Dallas, Austin, Houston, Jacksonville, Orlando, Charleston. These are the areas that are witnessing much stronger growth than the rest of the country. And these are your real economic drivers, from a geographical sense. And you can see that depicted extremely well in this chart that I thought was really informative and insightful, that the share of GDP for the U.S. as a whole is the portion coming from these areas is increasing at a pretty rapid clip. Here we have a lot of numbers. This is from Charlie Bolello. We have a few charts from him this week, and basically in 1 month, we've increased the size of our national debt by $1 trillion. So if you go back and remember, those dark days when we were worried about the debt ceiling and all of that, well, once that was lifted, that issue went away. The Treasury had to pay its bills and issued a whole lot of debt. I mean, and Charlie's piece this week, he kind of likened it to a drunken sailor and how they spend. But to say that that is probably an insult to drunken sailors, because the rise in total in national debt by $1 trillion in essentially 30 days is astounding. Here we have federal budget surplus as a result of issuing a lot of debt, paying a lot of bills, but increasing our spending. You can see here that our deficit is accelerating. That dip there is obviously a lot of the stimulus payment. And so even though we're not necessarily issuing stimulus, we kind of are, because we've got the CHIPS Act, we've got some of these other infrastructure programs, which is increasing our spending and as a result, increasing our deficit. Here is the manufacturing PMI. I talked earlier about manufacturing being in a recession. And you can see here that number's at 46. So anything above 50 represents expansion. So we've been in contraction in manufacturing for some time. But here Charlie makes the assertion that generally if you get down to this level, you're going to have a recession, right? Now, but we've talked about, well, maybe we're not going to have a recession. Well, if you're not, it's pretty rare by this metric. And so, you've got to go back to 1995 to 96 to see the last time that we were at this low level of the Manufacturing Purchasing Managers Index, where we did not have a recession. So it's actually somewhat rare to not have a recession with a number this low, but it has happened. You just have to go back a long ways to find it. Here we have manufacturing construction spending. So I just said that the manufacturing sector is in essentially a net recession, and that's true. However, as we saw, previously, a couple charts back, the federal deficit is increasing because spending is increasing, and it's having a very profound impact on construction spending here. Just think about the CHIPS Act and other infrastructure development. So that's leading to more overall construction within manufacturing, even though we're in a contractionary period right now with regard to overall activity. Here we have the money supply, Bloomberg chart here going back to 2017. That number is typically positive, but obviously after the stimulus went away, we had a net contraction in money supply. And we've been talking about this for a while, and there's one way to help control inflation. It's taking the punch bowl away and reducing your money supply growth, because you have a greater supply of money chasing fewer goods. Well, there's your definition of inflation right there. Well, that number was going down for a long time, but we just in this last reading saw an uptick. Now, I don't know where this goes from here. It's worth noting that, if you see a re-acceleration in money supply, that would not bode well for continued declines in inflation. But then you got to ask yourself, where is that money supply coming from? Well, if the Fed is issuing more debt and not tightening or shrinking its balance sheet, that would be one way to do it. But I really do think the Fed is focused pretty hard on not continuing, or basically they're focused on shrinking their balance sheet. So I would expect this to not be a trend and us to continue on this path of real limited money supply growth, which will help bring down inflation. We'll talk about the market here a little bit. We've got the S&P 500 trailing 12-month price to earnings ratio, and this is a 10-year number. And we've got two averages here. We've got the 5-year and the green dotted line, and you've got the 10-year average and the 10-year, or excuse me, in the blue dotted line. And you can see that we punched through both of those. Now we're not egregiously overvalued, but we are not at all cheap. And this is the argument that we've been making in the market. Now, what does the market need for, what is the fertile ground that they need for continued growth? Well, obviously, you don't want interest rates, moving up. That's typically bad, and we've learned not to fight the Fed, but yet this year the Fed's been raising rates, and, we have seen, at least a chunk of the stock market go up, all of those technology stocks that are tied to AI. But clearly, if you look at the trailing side of it, we're not cheap. Well, here's the forward 12-month price to earnings ratio. As you recall, we were kind of around 22-ish on the trailing. And here on the forward basis, we're still, above 19, which again is above the 5 and the 10-year averages for valuation. Here we have a chart on earnings growth, and this is a real bugaboo. So we've got a forward price to earnings ratio that is above average. And then you've got earnings that are in deceleration, and I highlighted this box in red here. That represents the index, because right now the expectation for second quarter earnings growth is for negative 7%, 7.2% to be exact, and that has actually accelerated a little bit from where we were at the end of last month. And we look at the sources of that, and you see energy, materials, healthcare all contributing to that negative year-over-year growth, which is offset by, oddly, consumer discretionary, when we're at a time where we would expect that to be perhaps weaker because of higher interest rates and purchasing power concerns and all that stuff. Well, the net of all of that, all of those various sectors, is that you've got some sectors that are they're obviously in witnessing year-over-year growth, and those that are really dragging down. But negative earnings growth here will be interesting to see here in about roughly a month, when we conclude this quarterly earnings season, to see where we end up. But obviously, you want to be cognizant and well aware on any particular earnings reporting season where you have negative earnings growth. Here we have the S&P 500 forward earnings yield less the 10-year Treasury. And so think about this for a little bit. Earnings yield is basically earnings divided by the index level. So earnings of the index divided by the value or the level of the index. So call it, like, instead of a price to earnings, it's more like an earnings to price ratio. So it's like an earnings yield. How much earnings are you receiving, for the value of the index today? And then you subtract from that the 10-year Treasury. So and you can see here very clearly that we have touched levels that we haven't seen since 2007. And so what did this really mean? I mean, it just said essentially you've got two things going on. Well, in a sense, you do have kind of flat to rising 10-year yields. So that is creating less headroom. But also you've got an appreciating equity market too. So you have, the market is moving higher, so your earnings to price ratio, or your earnings yield, is going down. And then you subtract from that a flat to rising 10-year Treasury, and that gets you to where we are now. And so, say that, this, as far as like, how does this inform our expectations for the future? It just tells you that things are not cheap. Here we have a quick survey from Bloomberg, found in some research. With this Pollyanna feeling out there that if you turn on CNBC and you really get a sense of this, listening to the people that they talk to. However, the strategist estimates for basically market action in the second half are really dire when you get right down to it. Everyone could be wrong, and a lot of people were wrong in the second half. So there is that. But right now, as it stands, the expectations for the second half of the year for the S&P 500 are really not that great. Well, still on the topic of the S&P 500, we've talked a lot about the lack of breadth in the first half of the year. The market was up, but it was really driven by the Magnificent Seven, or whatever you want to call it, these technology stocks with super high, egregiously high multiples that are tied to artificial intelligence. Well, here's a kind of an update to that, where we are now. You can see how it's evolved over time. So it's not like this has never happened before, where we've had a concentration of influence in this index. But you can see here the top 10 holdings now represent 30% of the overall S&P 500. And again, the S&P, every once in a while will actually have 500 members, but usually it ranges anywhere between like 498 to 503, or something like that. But just for simplicity's sake, if you assume that the top 10 represent 30% of the index, then you've got essentially 490 companies that represent the other 70. Here we have a bit of a histogram kind of showing us, what percent of the index, the index constituents are reporting, and by what week. So obviously we're sitting here on the 16th, and so we're really ramping up. Now we're going to hear from a lot of companies next week, but the really big week is the week of July 28th. And that's going to be extremely telling. We've got half the index that's going to be reporting then. So, if we're going to see volatility in the market coming up, and if some of these pundits are right for the second half of the year as far as price targets, this dire outlook that we just looked at on the part of strategists, I think it's all going to begin at the end of this month. Because we're going to be hearing from all these companies, and if the conversation is not as productive, then I think you'll see volatility in the market. If the conversation is, yes, I think we may have dodged a bullet, we're managing pressures adequately, but prices are coming down and it's giving us relief, yada, 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 then I actually do think that there's more staying power in the equity markets. But if I had to put money on it, I'd say that maybe we're going to have a bit of volatility more than we've seen lately. Here we have a chart on the relative value of international stocks. So in some of our recent rebalancing, we've kind of increased our allocation in various sleeves in international. But you can see here the discount. There's an average discount of 16%. That just means that the price to earnings ratio for international stocks has historically been at about a 16% discount to the valuation on U.S. stocks. And right now, that discount is 35%. So one of the justifications for our increase in international, even if we might be in a period of global kind of economic slowdown, is that the valuations are just too attractive to pass up. That we feel that that there is a catalyst on the horizon. It may not be tomorrow, but the valuation differentials are just too attractive to pass up. That's all we have for the chart pack this week. Hope you've enjoyed the presentation. Hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.